Hello everyone, we'll be going through all of my individual holdings today held on Trading 212. I hold just 9 individual companies that together have a value over £36,000 and I invest in them because of their competitive advantages, dominant market position in their industry and their fast growing free cash flow. So we'll be reviewing these positions to see how they've been performing so far this month in July. However, slightly differently from normal, I'll also be revealing to you guys my watch list. We'll talk about the lesser known stocks I hold on that watch list held on Trading 212 and maybe explain the reason why I'm keeping an eye on them. Kicking off with the overall return of this portfolio, which is up just over 4% at 4.62%, around £1,495 or so. And this is mainly because over half of this money has only been invested for just over a month in this account, which I switched money into from other accounts just after April for the new tax year. So at the start of April 2024, this account actually stood at around about £6,000. So that's quite a bit of difference. Additionally, the pound is actually the strongest it's been in nearly 2 years against the dollar, which is great for investments that I make right now, but when we take a look at our positions shortly, it has quite an effect as they are all held in dollars, which brings most of my positions down by around 2% or so or more in some cases, if I was to sell them now, which I'm not planning on it. Moving along, we have my cash position, which is over £2,330, which makes up around 7% or so of this portfolio, acting as a sort of buffer if I want to add to these positions or add a new position. A very likeable thing about holding cash on this particular account with Trading 212 is the 5.2% interest rate for the year I'm receiving on this amount each and every day almost. So it's paid out daily and that's quite nice because when I do see that investment that I like, that will get reinvested as well. So that makes holding cash actually quite desirable. However, I'm not just massively good at doing so. Let's start with my biggest holding. First one, you have Amazon, which is up over 5% in the green by over £300. And I have 46 shares, which hasn't really changed at all recently, although I did consider adding despite this one's even higher and higher highs that it's seeing. Valued close to around £7,000, but we're not quite there yet. We did breach that earlier in this week, but unfortunately it's back down to reality for me. And my cost per share basis is around $180 per share. I was actually considering buying, and I was buying around the $150 mark. But then I added to it quite heavily when we got that influx of money around April and May time. So that's the reason the share price and the cost per share is as high as we see. Interesting enough, I still think Amazon is undervalued according to historical metrics. Considering their price to operating cash flow is still hovering around that 20 times pre-operating cash flow, and historically for the past 4 years it's been well above that. So that makes up around 20% of the portfolio. I'm still very bullish on it and I may continue to add to this position if it goes on any dips in the future. Next on the list is Salesforce, which is pretty much flat, valued at around £6,200 or so, with 32 shares and a cost per share basis of $248 per share. As I spoke about before, the dip they went on after their earnings report was in my opinion quite unjustified. I have used that to lower my cost basis and I'll be interested to see what the next earning call brings for this company. Now it makes up just over 18% of the portfolio and I'd prefer that to change and go down a little bit in the future, but it works for me for now. Vici is my next biggest one, down £138, so that's over 2%, valued around £6,000. However, as we mentioned earlier, if we look at the FX impact or difference between the pound and dollar for this one, it's nearly 3% in the red, and that's eating into our overall flat or slightly up position. My cost per share basis sits at around $264 compared to a share price that's over $266. and it is over 17% of the portfolio now, which I quite like, and I'd be fine with adding to around to the 20% mark in the future. Then we've got Vici Properties, which is actually been doing very well. And I have 160 shares valued at over £3,600 and a cost per share of around $29.53 per share, compared to a current price over that of $29.71 per share. So again, the FX is hitting me quite hard, around 2% for this one, and it's currently around 10% of the portfolio, and I'm just fine with that level. It helps with the dividend snowball effect that I'm trying to create with this company, with dividend growth and high dividend yield companies. Then we have United Health Group, which is in the green by just under 10%. £240 up on the position, which is valued just over £2,800. And I have 7 shares at a cost share basis of around $451. And this is another one that's done very well, up over 3% for the month. And a few people have actually raised guidance for this one, probably because tech is actually probably just down. Its weighting sits at over 8% for the portfolio. Then we've got Mercado Libre, which I did a video about quite recently, so feel free to check in on that, and where I discuss the sort of business itself and give my views on its current valuation right now. So I own 2 shares up close to around 6% in the green by £150. Now it's a position that's valued over £2,600, and I have a cost per share basis sitting at around $1,617 per share. And I'm a big fan of this one and what they are doing with the fintech and e-commerce side of their business. With its weighting sitting close to about 8% in the portfolio, I like it below 10%, but we will see. If it goes in future dips for any particular reason, then we may add to this position. Moving swiftly along, we have S&P Global, which has actually surprised me quite lately, shooting up to over 10% in the green fairly recently by up over £230, with the position value just shy of that £2,600 mark. Again, we've had analysts raising guidance on this one, so that may be the reason why. I've just got over 7 shares at a share price around $419 per share. And again, this one is getting smashed by my FX impact at close to 4% in the red. It sits at around about 7.6% weighting as part of the overall portfolio, which I wouldn't mind being a bit more given the monopolistic model that they operate in the ratings industry, but we will have to wait and see, and I won't really be adding given the current run up in share price recently. I still think intrinsically it's overvalued at the moment. Then we have probably my best returner, which is of course Texas Roadhouse, which has just smashed it and is up close to 40% in the green by up to £680. The position is valued close to that £2,400 mark, and I own 18 shares at a cost basis around $118 per share. It's around 7% of the portfolio, and a lot of that is from gains. But with the dividend growth and fundamentals improving from this one, I'm actually happy to hold it at this stage and continue to collect that dividend. Finally, my last position is little old Microsoft, hiding there with its 2 shares valued at over £700, up around 36%, and in the green by about £180. And I say it every time, and I'm going to continue to say it. I wish I'd bought more, and I will forever kick myself over it, I'm sure. It only makes up about 2% of the invested part of this portfolio, and that's just terrible for such a high quality company that I kind of wish was a main holding in the portfolio. So that's about it for the current positions front. I'd like to have shown the portfolio when the pound wasn't so highly priced, but it's a reality of investing in American companies. Now, all of these ones have competitive advantages and fast growing free cash flow, or in the case of Vici, funds from operations. But what about the watch list? Well, as promised, the watch list contains companies I want to keep an eye on because they have great positioning in their industries or are similar to the companies that I already hold in my portfolio in the way their fundamentals work. Straight off the bat, we have Evolution AB, or EVVTY, which is an online casino operator that pretty much designs games for online casinos, and then they rent that out to different gaming operators. Now, it's not an American company, and they pretty much dominate this space of online casino game making specifically. And I actually owned this one close to a year ago and sold it for over 30% gain, if I remember correctly. So I bought around the $90 per share mark that we see here, and then I sold around the $125 to $130 mark before it actually went on a dip, which is surprising for given my normal track record for timing. So I keep an eye on it because I actually like the business, but I was waiting to see what the regulation might look like, specifically in Europe and America, before buying a sizable position in this company. So we will have to see with that one because I'm still not fully convinced by it. Then we have your typical ones like Google, MasterCard, Netflix, and of course Microsoft. I won't really touch upon them as it's obvious why they are there if you ask me. Circling around back to the top of the list, we have Airbnb. This is an excellent company with great branding that has created a great runway for growth in a very competitive environment that they're already operating in. So this one would be a great investment. However, there is a problem with regulation, which is a massive concern for me with more recently what's going on in Barcelona. They've recently decided against tourism rentals licensing in the city. And this isn't the only site which this is happening to, specifically against Airbnb. So I'm watching to see how they navigate this regulation and see how they perform in terms of their profits and margins. But they have done fairly well year to date in accomplishing recovery from regulation. So we'll see how they get on. Then I've got Fair Isaac and ServiceNow, which is two extremely dominant companies in their field, which are fast growing. Fair Isaac have a monopoly in the credit ratings industry, and ServiceNow is an innovative cloud-based sort of IT service. But they very rarely go on dips and are very highly priced and highly valued right now. But I keep an eye on them just in case they do go massively down based off earnings reports and a few other things, as I maybe would like to add to these positions in the future. So Axon is on here because through my work I've actually probably used all of their products, from their body worn video all the way over to their tasers, and their tasers are pretty much untouched as a monopoly throughout most of the world. It's such a niche monopoly, at first glance you might not even really notice it with this company. The X10 taser is actually amazing. There's lots of good things about this product in general, and most workforces are just going straight from the X2 taser all the way up to the X10 and skipping the X7. But all of them are buying from Axon. It's making them so much money with so many back orders filled that I really like what this company's doing in that space. However, I'm constantly put off by the valuation that Axon always seems to trade at. It's at over 120 PE and a price to free cash flow of over 130. And I can't justify that in any realms of possibility of buying at that level. But you never know what the future holds, so I keep it on the watch list. The final one I actually want to talk about is probably Wise PLC, which is a UK company, which is crazy for me, I know, but I do live in the UK, so I do actually watch a few of their companies. However, they have a very interesting company and business model. They actually aim to make international money transfers cheaper and simpler. So they partner with big banks like Monzo and Bolt to facilitate international banking and make it quicker. Why I think they have slightly a competitive advantage against the other banks doing it themselves is because of the time that it takes. Generally, it's considerably better from Wise's perspective of doing that transfer in terms of how many days it takes the company to transfer the money. But it's a very speculative one. Their free cash flows aren't fully representative of the high value sort of business outlook that they offer, and it hasn't really hit their free cash flow numbers yet. It's only hit it once in 1 year, and then it came massively down. So I have to keep an eye on this one, but I want to see steady growth in that free cash flow before I commit to a company. So that's about it, guys. I hope you enjoyed this. We walked through my my stocks and shares ISA, and of course talked through my watch list. But that's just my point of view. If you want to talk about these other companies, or if you want to hear about any of these companies, and I'll talk about them in a bit more detail in other videos, then please feel free to let me know down below. And as always, thanks for watching. I do appreciate it, and I will catch you in the next one.